What's going on, everyone? Welcome back to the Financial Freedom Show with Chase Lawson. If this is your first time tuning in, I'm very glad to have you. My name is Chase Lawson. I am a personal finance fanatic and the author of Financial Freedom, Breaking the Chains to Independence and Creating Massive Wealth. People like to make personal finance seem confusing and complicated, but it doesn't have to be. And with each episode of this show, I strive to take a different topic and break it down for you so that you can better understand it, know the pros and cons, and make the best, most educated decision for yourself. By just taking a few minutes each day to learn a little bit more and then apply to your own life, you can become financially free. Before we get started, my only ask of you is that you go ahead and like this or leave a review if you get value out of it or learn something new, as well as subscribe if you haven't done so yet. Now let's dive in. Today I wanted to address a pretty common question I see and hear every day, which is when should you buy and when should you sell a stock? And that is a great and important question. If you're listening to this episode, you may have the same question. And if you're already investing or thinking about getting started in investing, I want to first take this moment to applaud you, as investing can be pretty powerful and help you achieve financial freedom. Now, before I dive into this question, I wanted to start by just giving you my general rules of thumb when it comes to investing. As a general rule of thumb, for the average everyday investor, they should look to invest in low-cost, diversified index funds, which I discuss more in depth in my Stocks 101 Part 3 episode or episode 5 of the show. And the best time to buy was yesterday, and the second best time to buy is today, while the best time to sell is never. That's obviously a bit of an exaggeration, but it's pretty impossible to time the market, and it's more important to stay in the market for as long as you can, which I discuss more in episode 6, Index Card Rules to Investing, as well as episode 18 on dollar cost averaging. However, despite my advice, I know that most of you listening will probably still invest in the occasional company or two here and there, which is definitely fine. I still occasionally do as well, but it's more rare for me as I've been burnt by some bad investments when I was newer to investing and didn't know much better. And I know that index funds will provide stable and effective returns for me without the added time and headache of trying to research individual companies and stay abreast of the latest news with each of them. And some people do still want to take a more active role with at least some of their investing money. So if that's you, go for it. Just set a limit and be sure you know what you're doing. And you should eventually sell your stocks so that you can actually use that money that you've built up. But obviously, the longer you have your money invested, the more impact compound interest will have on your money. So with that being said, let's jump into this question so that you know when to buy and when to sell. When making any decision, whether in investing or in anything else, one thing I like to do is consider the short-term and long-term ramifications of that decision. With any decision, you can either take action or choose inaction. And whatever you choose comes with opportunity costs, or what you're essentially giving up by not choosing to do something else with your time or money. Sometimes there may be no net impact between your short-term and long-term when making a choice. Other times there could be a huge impact, in which case it's important to weigh out the pros and cons and decide what is the best choice. If you do decide to invest, which you should, then you will have at least one buy transaction and at least one sell transaction. When you buy, you're setting those dollars aside for being able to be used to spend on other purchases, with the goal being to see an increase in value due to returns on the market. That's pretty simple to understand. However, one extremely important thing to keep in mind is that you don't actually gain or lose money until you sell an investment. Until you sell, they are considered unrealized gains or losses. This is important to understand because a lot of people, especially beginning investors, freak out when they see their investments go into the red or even just have a single negative day. Stock prices change every second of a trading day. Some days they go up, some days they go down. The only way to guarantee a loss, though, is by selling at a loss. However, Whenever you do ultimately sell any investment, that transaction, if held in a taxable brokerage account, which your non-retirement account dollars will likely be in, will come with tax implications. If you sell your investments at a gain, you will owe taxes on the gains. And if you sell at a loss, you will likely be able to deduct those losses from your taxable income, saving you on taxes. Typically, with most investments, taxes are not withheld from your investments the way they are with your paycheck, meaning when it comes to tax time, you will then be liable for any taxes not already withheld, including on your investment gains. So why is this important? This is important to keep in mind for both gains and losses. Let's say you've made good investments that have returned a profit and you decide you want to get out of that position so you can use the money elsewhere. This may be for many reasons, including trying to avoid having too much of your net worth in any one company, believing there may be a better investment than the one you're currently in, or you may just need the money for whatever reason. It's important to keep in mind timing here. Taxes are due for most people by April 15th of the following year for any income made during the current year. So 2020 taxes are due by April 15th of 2021. It is December currently, so if you sell your investments at a gain right now, you will owe taxes on that money within the next 3 or 4 months. This could lead to you having to send the government money, meaning you may need to keep some of this money set aside. However, if you just wait a little bit longer until January and then sell, you won't owe taxes on that money for about 15 months until April 15th, 2022. So you have a longer time window to use that money before you owe the taxes on it, which essentially provides you a longer period of an interest-free loan from the government. For me, I'm invested in my employer's stock purchase plan, so I get to purchase shares at a discount, which is great. However, I've been with the company for 4 years now, so I now have more invested in my company than I probably want, so I do plan to sell some of the shares I initially purchased so as to lower my exposure and risk to one single company. However, I'm waiting to sell right now, even though the price is at a good point, because I want to keep my taxes lower and already expect I might owe when I file my taxes in April. This is more important though on the losses side. As I discussed in my episode reviewing Wealthfront, you're allowed to deduct up to $3,000 in net capital losses or net losses on your investments per year if single or married filing jointly. If married filing separately, you're each allowed to deduct only $1,500. Any excess above the allowed amounts can be carried over into future years, so if you made a bad investment and you're already thinking about getting out of it, it will be smarter to do so now in December than it would be to wait and do it in January. If you do it now, you can get those tax savings when you file your taxes by April of 2021. If you wait until January, you won't see that benefit until you file your 2021 taxes in early 2022. I personally made some bad investments when I was younger before I realized how much better index funds were, and I've been holding on to them for a while in the hopes they would recover. However, I've decided that money is ultimately going to be put to better use in an index fund, and I'm trying to reduce my tax burden, so I am planning on selling off some of those investments soon, before the new year, so that I can get those tax savings. If you're in the 24% tax bracket, this could save you $720 in taxes. So now that those generalities are out of the way, what are other important considerations to keep in mind when trying to decide when to get in or get out? Let's start with the buy side. First and foremost, when a stock goes on sale, could be a good time to get in. As I mentioned, stocks go up and down each and every day. We'll have bad days, weeks, and months on the market from time to time. As I mentioned in my first episode on coronavirus and investing, historically there is one market correction per year, which is defined as the stock market dropping 10% or more from a recent high. Investors usually panic when this happens. However, this presents a potentially great time to invest since most stocks will be on sale. Further, every few years we will experience a bear market, which is most commonly defined as a 20% or more decline from market highs that last for several weeks or longer. The coronavirus pandemic ended the longest bull market we've ever had, which lasted for about 11 years and resulted in a bear market that has since recovered. It's important to point out that the market as a whole has always recovered. It just takes longer sometimes than others, so it may be several years or may only be a couple of months until it recovers, but the broader market has historically always bounced back. So once again, this does happen and it's not something to get overly concerned about, but rather presents a great opportunity for investors to pick up more shares of stocks at beaten down prices. With the COVID market crash, that was only short term and lasted from February 20th to April 7th, 2020, before the market re-entered bull territory. The S&P 500 closed at a record closing high on February 19th at a price of $3,386.15, and by March 23rd had dropped to a closing price of $2,237.40, or a decline of 34%. While many freaked out and sold their investments, that actually was a great time to buy more, as the S&P 500 is now around $3,700. Had you invested on March 23rd, that would have been a 65% return on your investment in a 9-month span. Another way to help determine when to buy is if a stock is undervalued. A more advanced way to do this is through a valuation technique known as discounted cash flow analysis to determine the theoretical price target. However, that can be pretty confusing and complicated to explain and not a necessity. Other ways to determine if a stock is undervalued is to read analyst reports and look at their consensus price targets for a stock, which you can get directly on most financial websites such as Yahoo Finance. These price targets will show you the low target, the high target, and the average of all analyst opinions. If a stock is trading below the consensus price target and it is well followed, it could present a good buying opportunity. However, do keep in mind that nobody knows what will happen. These are just best guesses from those in the industry, and it may take weeks to hit or may take years to hit that price target. But in general, the target price is where analysts believe the stock will be trading a year from now. Another way to help determine if a stock is undervalued is to look at its price to earnings, or PE ratio, compared to others in its industry. PE ratio is price per share divided by earnings per share, so the higher a stock's price, the higher its PE ratio will be, and the stronger a company's earnings are, the lower its PE ratio will be. You can find this listed out on a company's stock page on whatever financial site you use. If a company's PE ratio is much higher than that of its main competitors, it may be a sign that the stock is overvalued, since the stock is trading at a higher multiple of the company's earnings, whereas if it is lower, it may be undervalued. Do keep in mind this will vary per industry, which is why it's good to look at a company relative to its industry. For example, U.S. coal companies in January 2020 had an average PE ratio of around 7, whereas software companies were above 60. Some companies may have negative PE ratios, meaning they had a net loss on the year. This is common with companies in the biotech and life sciences industry, as they often spend hundreds of millions of dollars developing new drugs that usually take years to hit the market. Further, Uber and Lyft have never returned a profit, so their PE ratios have always been negative. However, many analysts may consider them to be a good investment. So take PE ratios with a bit of a grain of salt, but a good example to look at here is Tesla. Tesla was added to the S&P 500 on December 21st of this year. This positive news led its stock to hit a new high on December 18th of $695. That put its PE ratio at 1,328.87, which is absurdly high. The consensus analyst price target is only $396.30, which is about 57% of where it closed on December 18th, and 3 analysts recently downgraded their recommendations from either strong buy or buy to hold or neutral. I love Teslas. I would love to have a Tesla. I love Elon Musk as a businessman, and I think he's doing some cool and innovative things, but I see that PE ratio and that just screams red flags to me. Now, Tesla is very innovative and it's hard to compare it to other car companies, but Ford has a 0 PE ratio, Honda has a 5.13 PE ratio, and GM has a 18.39 PE ratio. Should Tesla be trading at over 72 times what GM is comparably trading at? Probably not. Finally, always make sure you have done your own homework before investing in anything. Analyst price targets and advice of financial newsletters may be a good starting point, but do your own homework and due diligence. Have you ever read a company's annual report? There's a lot of great information in there that they are required to disclose if they are a public company. Check out recent news releases or see their recent presentations to investors or at industry trade shows. You can easily find this on their websites under their investor relations page. Be cautious about investing in a company right after positive news stories come out though. This usually is when a lot of investors may rush into a stock, which drives the price up, perhaps too artificially high. You may consider starting with a business or industry you're already familiar with. As I mentioned in Index Card Rules to Investing episode, never invest in something you don't understand or can't explain to others. That just will lead to trouble. Is the company a good investment? Does it have sound financials and growth potential? Some things to potentially look out for as red flags are companies that have stopped earning profits, or companies that are under investigation, or that have a lot of debt relative to others in their industry, or who have recently cut their dividends. These could all be signs that a company is in trouble, and while you could get shares of these companies at a major discount of where they once were, if they're in trouble, they may not survive and they may not bounce back. Know your risk tolerance. If you're going to panic and want to sell every time a stock price goes down, perhaps invest in safer investments like index funds. So that's some of what you can use to know when to buy a stock. But once again, my general advice is to invest in index funds. It's easier, much lower risk. You can still earn a great return, and you don't have to spend all this time doing analysis of individual companies and trying to stay up to date with each of them. In addition, my other general recommendation is to just dollar cost average and invest a little each month, whatever you're comfortable with. On the other hand, though, how do you know when to sell a stock or when you should sell a stock? First and foremost, when investing, especially if in individual companies, you should set a target both for entry and for exit. A lot of people go into a stock without even giving a thought as to what their plan for exit is. You have to have a plan, otherwise you're never going to know if it makes sense to sell or not. Whether it's, hey, I'm going to get out of this stock after I've made a 20% return, or hey, if this stock ever drops 30%, I'm going to go ahead and get out to limit my losses. Or both, or some other criteria you set, you need to have some parameters in place. Aside from that, there's really 5 main reasons why you might decide to sell. First, the reasons you bought the stock no longer apply. You make a decision to invest in something for a reason. What are those reasons for you? Why did you buy the stock in the first place? Do these reasons still apply? If not, it may make sense to get out. If so, you probably should consider staying in. Just because your stock may have doubled in value doesn't mean you need to go ahead and sell it, especially if it still meets your investment criteria and you think it still has value. Something you can ask yourself whenever you look at your investment portfolio is, would I buy this stock today at today's prices? If the answer is yes, keep holding or maybe invest more. If the answer is no, well, that may mean you should go ahead and sell. The second reason is if the company is being acquired or merging with another company. After an acquisition is announced, the stock price of the company being acquired usually increases to a level that is close to the agreed upon price of the acquisition. In these cases, it may be wise to go ahead and lock in your gains since there may be limited upside potential. If the deal ends up falling apart, which there's always a chance it could, your shares could come crashing down. In the event it's not an all-cash acquisition and shareholders of the company being acquired will get some shares in the acquiring company, then it comes down to whether or not you have a desire to be a shareholder in the acquiring company and if the acquiring company meets your investing criteria. Reason number 3 is if you need the money or soon will. Any money you may need in the next few years should probably be kept out of the stock market. So if you have any major purchases coming up or are nearing retirement, it would be wise to pull some money out so that it's not at risk in something volatile like stocks. Reason number 4 is if you need to rebalance your portfolio. As I mentioned previously, I have a large portion of my investing portfolio in my current company, so in order to lower some of my risk, I plan to sell some shares and put that money into other investments, most likely an index fund. Another example is if you invest in high-performing stocks that may double or triple in value within a few years. This is a good problem to have, but may not be wise to keep so much of your money invested in a single company or in a single industry, so as prices change and the relative weights of your holdings change, you may decide to sell some to get back to your target allocations. In addition, as you get closer to retirement, you will likely want to lower your exposure to stocks, so you may decide to rebalance your portfolio by shifting some of your investments out of stocks and into bonds. And the 5th and final major reason to consider selling is if you see a better opportunity to invest elsewhere. Ideally, you can just invest other spare cash into this other opportunity, but that may not always be possible, so it may be smart to sell an investment you think has a less attractive opportunity for one that has a more attractive opportunity. Never sell a stock just because its price changed. Making decisions on price alone can be dangerous. You may sell an investment too early that has gone up for a reason and still has tremendous growth potential. And conversely, many investors make a common mistake of selling just because the price has gone down in order to prevent things from getting worse. However, if the whole market is down, then most investments will be down. And if it's still a good company to be invested in, you will miss out when the price does eventually recover. And once again, in order to reduce any confusion or complications around this and to prevent even having to make these decisions, strongly consider investing in index funds that are diversified across hundreds or thousands of companies that move with the broader market. This will save you so much of your sanity and allow you to focus on more important things like finding ways to increase your income in other places. Well, there you have it, everyone. Now you should be better armed to know when to buy and sell stocks or any investments. Thanks so much for tuning in to today's episode of the Financial Freedom Show with Chase Lawson. If you have any further questions or comments, go ahead and drop me a line. And once again, if you like this, please leave a review or like this. And finally, please subscribe so you don't miss out when I release future content. I hope you have a great end of your 2020 and an even better start to your 2021. Until next time, thanks again, stay safe, and go get 'em.